Hello and welcome to Dr. Jam's Jam, where we mash up energy, carbon, forest, agriculture, and waste, and look at effective and not so effective climate and economic strategies. This is the first of our three-part series on thinking about forest carbon like financial statements. Today is Income Statement Day. If you have a business or policy background and have always wondered how bioenergy could possibly be considered low carbon, this is for you. Let's jam. Look, I understand that people are emotional about trees. And when we talk about forest management, forest carbon, and the trees that make up forests, we need to keep in mind that trees are plants. The reality is that we kill plants every day. We eat them, we feed them to animals, and we use them to make products, like lumber for our homes. These plants are continuously growing and dying, whether we like it or not. So how do we approach forestry without emotion? Well, we can compare it to accounting. We can think of carbon accounting in our forests and forest carbon statements just like we think about financial statements for a person or company. This is not to say carbon is the only consideration for forests. When we sustainably manage forests, we need to consider the value of the other benefits that they provide as well, including biodiversity, wildlife habitat, water, air, recreation, and economic development. We can weigh these different values in our forest planning, but carbon is important, and we need to understand it properly. So let's first get on the same page about financial statements. There are three primary financial statements for any company: an income statement, also known as a profit and loss or P&L statement, a balance sheet, and a cash flow statement. Let's start with the income statement. It shows revenue and expenses for any given year. The revenue minus the expenses gives you the net income or profit for a year. If expenses exceed revenue, the company has a net loss for that year. If revenue exceeds expenses, the company is profitable. Large companies like Apple have billions of dollars of expenses, but they have even more billions of dollars of revenue. And so they are profitable. Now replace the dollars, euros, pounds, and yen with carbon, and instead of a company, think about a forest. Every year, there are significant expenses in the form of carbon losses from the forest. These can be from timber harvest, but they can also be from wildfires. In fact, the largest carbon expense for most forests is mortality. That is, the natural losses from leaves, branches, and end-of-life trees being broken down and released into the atmosphere as carbon dioxide. People tend to focus on these carbon losses or expenses in our carbon income statement without ever considering the revenue. This revenue is growth of the forest. Every year, the forest is growing, sometimes slowly, sometimes quickly, depending upon its age, how it is managed, the climate, and many other factors. It is that carbon uptake that is our revenue. There are lots of tactics to ensure that a forest is profitable. That is, it is storing more carbon than is released. Sure, we could eliminate carbon losses and increase the profits by not cutting trees. However, in a lot of situations, we can increase the carbon profits by cutting down trees. Say what? It's true. By using sustainable forest management practices, we can selectively cut down trees in order to create a healthy, more productive forest. Initially, a stand experiences a carbon loss. However, in the long run, productivity and carbon storage is increased. If you want to find out more, I'd encourage you to watch part 2 of our 3-part series on thinking about forest carbon like financial statements. That one is focused on the balance sheet. Keep on jamming.